Good evening. Hope everybody is well. I'm having some technical issues here, but I hope all of you can hear me. Right, hope everybody is well. Let's get to the market quickly. I'm trying to get my thingy opened up, but it seems like I cannot. Hope everybody is well. Just want to open the charts quickly. The market is already reacting, man. 8 o'clock, but I will want us to obviously play the thing here. Oh, look at euro dollar already. We are seeing some upward movement there at 43,000. I mean, we are up by 43 pips already. Were we really expecting this? Well, this should be the opposite, rather. I think maybe then around 30:30 we're gonna hear something. I think around 30:30 we're gonna hear something. My analysis on British Pound USD today was this: buy at around $1.3626. Go to the upside there, and as you can see, we clearly went nicely there to the upside. I see some of you already hit TP. Yeah, I'm expecting a 25 basis point today from Powell. A lot of you are always asking me, Mr. President, what does that mean for these markets? Obviously, I'm expecting the dollar to strengthen once that comes out. Usually, when there's a cut, the dollar will react nicely and strengthen. And usually, you would find that the stock market will be dumping. There's a reason for that. USDs are down. Again, we'll also have a look at it. Where is it? I'm quite concerned. I'll be honest with you, man. Ooh. Ladies and gentlemen, this is the best time to withdraw. To make a deposit. I'll be honest with you. Choppers, we didn't have time to do a lot of things, so don't forget to like and subscribe. We're gonna play Powell live here on this channel. We're gonna play him live. And we're gonna find out what the gentleman is saying. I think he's going to start at 8:30, if I'm not mistaken. We'll check him out. All right, so already it's 25. Why is the market reacting like this? Let's take a listen. Let's take a listen to some of the stuff we can find here, especially on Bloomberg. Let's hear what's going on already.
I think the question that we're not asking is inflation itself. So is embedded in that forecast, is it still I'm sorry to say, transitory inflation component driven by tariffs that roll off over time? And so if indeed that is factoring in to the Fed, forward thinking,
that was inevitable.
Then that does mean there's more room for cuts because they're not as worried about that inflation component. So I would just be hesitant to look at the inflation number in abstract. I think what's driving it underneath is the key.
To your point, there is a very clean, dare I say, convenient glide path back down to 2% in the forecast from 3.1 to this year, 2.6 for next, 2.1 after that, down to 2 for core PCE.
Yeah, there's a big rebuttal on that, and that is in the dollar. And you mentioned this earlier. And the idea that long-term bonds yields are falling. You're seeing a rally across the board in everything but the dollar, which just hit the lowest levels going back for the entirety of this year. That is speaking volumes about exactly what you just pointed to.
We just took out 119 on euro dollar. Let's head over to Europe and catch up with Bob Michael at JP Morgan in the heart of foreign exchange in the city of London. Bob, great to get your thoughts. You've had about 8 minutes to go over this one. What jumps out to you, sir?
couple things jump out. Greg's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2 suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts.
Samuel, I think so, my friend. Let's wait for 8:30.
Perhaps every meeting for the next
8:30.
few meetings.
I think we'll get clarity on a lot of things.
To 3% right away. They pause somewhere around 3.5 either side of that. I get that. I'm sort of with the Fed. We don't really know the shape of inflation until we see the final shape of tariffs. Right now, the evidence is pretty good. Businesses have absorbed some of it, and the consumer hasn't really pushed back all that much. And there's been signs of disinflation. So I'm not that concerned about inflation.
Bob, your colleague Michael Feroli made global headlines a long time ago talking about a sub 2%.
This gentleman always makes me laugh, the way he speaks.
Without COVID,
he wears bow ties all the time.
Legislation. These median growth estimates today, do we have to get used to this? Sub 2% real GDP?
It doesn't feel like we're going to have to get used to it. It feels like we live in a world where policy will be generous on the accommodative side, both fiscal and monetary. We're looking at dots now, but we also haven't weighed in. Forget about tariffs. The One Big Beautiful Bill Act, that starts to hit in earnest in the first quarter. So I wouldn't be surprised to see GDP estimates go up next year.
For those of you just tuning in, about 10 minutes ago, 11 minutes ago, the Federal Reserve made the decision to cut interest rates by 25 basis points. There was one dissent, an individual looking for a 50 basis point cut. That was the newly minted Governor Myron, sent over from the White House.
Does he have a business card
at the Federal
yet?
Reserve. I want to get to something, TK. Check this out. Go to the dot plot and the projections. And if you go to the dot plot and you look at 2025, there is a very lonely dot at the very bottom of the screen, and it's sub 3%, not for next year, but for this year. There is a dot there just below 3% for 2025. Now, we were all asking, and of course, when you follow those things, there are no names on the dots. You don't know who they belong to, but I think we've got a pretty good idea who this might have come from. We've been asking how aggressive Governor Myron might be. The dissent is one story. The push for a whole lot more for the year ahead.
You mean 125 basis points of rate cuts by the end of this year seems a little bit aggressive? Look, to me, that is notable, and it might be exceptional for people to hear that and absurd if you think about the growth in the economy. And yet, how much is the market trading off this? And I wonder, how much does this have disproportionate weight in the market? Because this is someone who really is coming with the backing of the president and could be some sort of signification of who he might pick next year.
I can see this picture out the corner of my eye. So let's take this picture. And for our audience at home, I'm just going to articulate what we see on the screen right now. So you've got this lonely dot for 2025. And then in 2026, you've got this additional story to think about. This massive spread in expectations from individual policymakers of the Federal Reserve. Lisa, they have got absolutely no idea what 26 brings, what 27 brings. Correct. This is a low conviction Federal Reserve, and you've got to bear that in mind when you go into this news conference. These guys are not gods. They haven't got crystal balls. They are clueless going into next year.
We're all clueless. And when we were speaking today to some of the heads of retail banking, what we have seen is retailers themselves don't know how much they can pass along inflation, how much there will be this elasticity in terms of demand.
Greg Peters is not clueless. I'm looking at the Bloomberg Total Return Corporate Index. and it is a miracle price up and yield down. Do you predict that we will see these acclaimed indices, the Lehman, Barclays, et cetera, now the Bloomberg Total Return Index, they're going to break through and go through the highs?
Yeah, that's what I was expecting from.
I mean, we can have a new low yield regime that we just didn't think would occur.
I don't think
expecting
so.
this
I think
to
that's
obviously
heroic. I think the world
because
has changed
usually at times like this,
post-COVID.
people
I think the
lean on
environment of zero interest
coming
rates,
out of the
negative
stock,
interest rates will continue
indices
to be looked
and
back
get more
on
into
as a bad idea.
Getting
that
lows. I
drove
mean, at the
those
time like
rates
this,
to those
will be
levels. So I don't
Can we
think
go on the edge of Myra? I
cheap
guess
for them
that's the question. Can we find that
make
dot?
some borrowing.
I don't think you can get there
So,
without a
yeah,
recession,
Nasdaq makes
honestly. And I think it's important to remember
I'll remain
the
bearish
starting
on
place
Nasdaq
is
for
above
now.
neutral, right? So we're not even at the top of neutral yet.
Yeah.
So, the Fed still has room. They still can get to 4%, and they're neutral, right? And so we have a long way to.
Let's rather than wait for 8:30 as well. But yeah, this is what I was expecting from NAS 100. And I think we might see the strength of the dollar coming in. I think we might see a strength of the dollar coming in. Yeah, now it's down. We went all the way to $1.19. Ladies and gentlemen, anything below view up, I think first thing in the morning, I'm going to be selling this. Ladies and gentlemen, 64 people watching, only 19 have liked the stream. Let's do the right thing, please. We haven't marked the register. Someone is in the house. First man is in the house. First man, can you please send me a first text in the morning? I need to talk to you, my good sir. Make sure that you do a thing. I'll really appreciate it. Gosnati is in the house. Manessa K is also in the house. Manessa, I think, is the first time here, but we welcome you. Relaxing. Relaxing. It's been a long time, my friend. We've not seen you. Guruleko is also in the house. Robza is in the house. Passion of Christ is also in the house. Say good evening, Mr. President. Good evening to the choppers. Markets are moving. Yeah, indeed, my friend. Let's make some money. Let's make some money. The AI is here. Right, a recap of what we've been doing throughout the week. Again, we had a very beautiful week. Today is Wednesday. I think we had 3 trades already. We took 1 loss, 2 wins so far, and yeah, it's a thing. A beautiful week. On Tuesday, so we didn't have a live stream on Monday. We only had it on Tuesday, which was my birthday. Was it yesterday? Yeah, it was yesterday. I told you guys, reload at this price level here. We go to the upside, $62.62 per barrel. There we can easily go to the upside there. I'm looking again to see if I can rule out just above view up there. I'm anticipating at least $70 per barrel there on WTI. So that went in nicely. Looked for some buy setups on euro dollar. Still going to the upside. I mean, after the announcement, now we are up like 50 pips or so on the euro dollar, trading now at $1.19. British pound USD, as I mentioned, that there's actually an analysis group for, it's called the Stellar Octa thingy. I normally also send my analysis there as one of their analysts. So this morning I told them I'm gonna be buying at this level, $1.36, go nicely to the upside there. But yeah, don't be fooled by this. I think we can at least expect some strength coming in from the dollar, maybe sometime tomorrow. German, this was during the live stream. This is what I said I'm gonna do, guys. So when the live stream started in the morning, I said to you guys that I'm gonna be bullish on German, right? I'm gonna wait for a close above and go nicely to the upside. I was targeting 23,763 or so and go to the upside, but by German breaking below, and I did mention if we break below 23,700, which is also a psychological level, what I'm then going to do is I'm gonna wait for a retest, close up below my view up, take it to the downside. Let me know down in the comment section if you took this one. It was a beautiful trade. I actually draw this with you guys during the live stream and on Tuesday, which was yesterday. Let me know if you took this German to the downside. I will continue selling German. I'll be honest with you, around this level here, this is what I'm going to be looking at, taking this again to the downside. Also, it's going to be determined by how the VOP, the view up is playing around, possibly 23,500, 23,600, and yeah, so we are not looking to buy this. We are now going to the downside. So also let me know if you're gonna join me on this one. So I'm already preparing you guys for tomorrow, right? US 30, what did we say yesterday? So our analysis on US 30, we had a buy setup here. We hit TP at 45,950, which was again a psychological level. We spoke about reloading at this lows here, right? And went nicely to the upside. One can say, Mr. President, around this view up level here, don't you think we would have reloaded to the upside? No, not yet. Remember, because we were waiting for FOMC. But what I'm anticipating is anything that will close below this level here, I'm going to the downside. So I'm going to be bearish on my indices from tomorrow. Or let me say from tonight. I'm simply going to be bearish on indices. And I think most of my approach will be based on fundamentals. Someone say I had a break even on gold. It kicked out my trade. Was holding a position since this morning. It was at 1:1 risk to reward, so I just protected the $3 above the entry. It's still good, my friend. Still a good approach. Still a good approach. Still a good approach. So Powell is going to be speaking now in the next 5 minutes, and I think we're going to have a listen together. What are you guys trading? Please let me know in the comment section. Yeah, Betua, let's hear Powell's tone. What are you guys trading? For those of you that are saying President is drinking on the live stream, this is champagne, non-alcoholic champagne, by the way. So I have a bit of a tradition. Every time I have I had a long day, I'll be honest with you, and most of the time I was out of the office today. So when I had a long day, I usually it really calms me down, right? Remember I told you guys I quit caffeine, so yeah. I know it will be headline news tomorrow. He was drinking on the live stream. I don't drink alcohol, by the way. You know that.
We were in a recession because their purchasing power was eroding and they were losing ground. And I think that's very important because it really gets to the corrosive nature of inflation. And at the end of the day, you cannot get full employment sustained unless you really derail inflation. What we don't know is if this will just be a couple steps up.
Ladies and gentlemen, please let me also know that this session is not really for doing a lot of things like analysis and whatnot. This is just trying to figure out how we're going to approach these markets in the next coming days, guys. I always say to you, the live stream will help you, but at the end of the day, it must also help me, right? I'm here to also protect my interests. So right now, I'm like you. I'm figuring out what is my next move here. That's what I'm basically doing.
Matt, welcome to the program. What an interesting forecast mix. More rate cuts in our future. Growth apparently okay. Unemployment not a problem. Explain that one, Matt.
Yes, I think for the near term, it's pretty clear. They talked about increased downside risk to the labor market. And so this is all about risk management. It's not about modal forecasts at all. As you noted, growth is stronger, the unemployment rate unchanged for this year, inflation unchanged for this year. You can see it at the back of the SCP, their forecast. There was a little bit of a shift in the distribution of risks. Those officials that are more worried about downside risk to the labor market, less officials that are more worried about upside risk to inflation. It's basically in line with what we were anticipating. The Fed shifting in a little bit more dovish direction today, close call on the 2 versus 3 dots. I think the key question for Chair Powell is how much does he lean into the near-term signal of cutting at each meeting this year?
Do you get a sense, Matt, of how much the reaction function has shifted? John's done a really great job of talking about how from July to August, there seemed to be a shift from the unemployment rate to the headlines payrolls report. Do you have a sense of just how tolerant this Fed is going to be of inflation well above 2% for years on end and keep cutting?
Look, I think they're showing us that they're pretty tolerant above target inflation. In fact, if you look at their forecast for next year, they actually raised their inflation forecast by 0.2. They raised their growth forecast. They lowered their unemployment rate forecast, and yet we see a lower Fed funds rate. I think the reality is we are now projecting at 5+ years of inflation being at least 50 basis points above their target, and yet they are cutting rates into that environment. So I think it's a Fed where, as long as there are no worries about the labor market, they can be hyper-focused on inflation. But once some of those concerns about the labor market really manifest, you see a pretty dovish shift. And I think that's what we saw from Chair Powell at Jackson Hole, and we're seeing it manifested now through the dot plot.
Matt Lazzotti, Diane Swunk brought it up, and many others have as well. We're all focused on tariffs and substitution. Are we seeing a decline in purchasing power here? Is there an income effect from tariffs that the Fed has to fold in? And what is this, John, 50 more beeps they're going to do by the end of the year?
Potentially, yeah. Widespread of estimates, though, TK.
Win one of them.
125.
TK, Spurs are doing all right.
Yeah, they are.
They're doing all right.
Matt, purchasing power here. This is a huge issue for Americans, isn't it?
It is, no doubt. But, I think the main area where you would first see that is through consumer spending data. And I take Diane's point and the points earlier that there's great dispersion around that data, with that being driven by higher income households. At the same time, GDP growth is tracking above 3% in Q3. It was above 3% in Q2. Retail sales are robust. CapEx growth was strong. So I think it's a Fed where, even if you are seeing it eat into disposable income growth, consumer spending growth in the aggregate is strong, and monetary policy has one blunt tool, which is the Fed funds rate. So really, they're not apt or really able to get at a lot of those distributional issues. I think Chair Powell and the Fed would probably tell you that is more up to fiscal policy, tax and spending policies that we would see from the administration. So I don't think that this is really about trying to alleviate some of those distributional concerns. I think it's concerns about the aggregate labor market, which is not being manifested in strong growth at this point in time, and them just trying to get ahead of it and taking out some insurance against that.
Matt Lazzotti, appreciate it. One of the best, Matt. Thank you, sir. Matt Lazzotti there of Deutsche Bank. The news conference a few minutes away. We often hear people come on the programme and say, I expect it to be dovish, and really the response to that should always be dovish to what? Relevant to what? Relative to who and what and where? Relative to the market, this isn't dovish. Of course, we were looking for really bullish expectations for rate cuts in the next 12 months or so. But it's their own forecasts that make this dovish. The fact that the Federal Reserve is coming out and telling you, you know what, Lisa, next year, I expect a better picture for growth. I expect a slightly higher inflation print than we did a few months ago. But you know what? I give you some rate cuts to the mix as well. That's basically what the Federal Reserve has communicated in these forecasts today.
Yeah, the currency markets are hearing that loud and clear, and I think that is the biggest tell, and I keep going back to that with the Bloomberg Dollar Spot Index now at a new post-2022 low. We have seen it completely weaken, fall versus some of its counterparts. Why? Because of this prioritization of growth over inflation by the FOMC and a reiteration of that in this SEP.
Greg, I got to ask you a basic question. You've been doing this for a few years. When you read sell-side literature right now, economic think tank literature, can you trust the forecasts?
Well, yes. I mean, I think forecasts are always fraught. The dot plot is no different than a sell-side forecast. It's not like they come with any additional information. But I think in this particular period, when there's so much going on, and I hate the word uncertainty, but it is the right word. I mean, we've been talking about tariffs as an example. We have a Supreme Court decision coming. We don't know what the shape of tariffs is going to look like after that, just as one example. So, so it's a really difficult environment. So you should expect to see more dispersion. What the markets are trying to suss out, what I'm trying to suss out is what's real and what's political. And I think that's an open question, and time will tell on that front.
Is the political real?
Well, the political is driving the real.
They're going to be the same thing next year, aren't they?
Yeah, no, absolutely. And I think this is the world, or this is the investment realm that we have to deal with. And so it's not going to change anytime soon. But this was an incredibly dovish SEP and dot plot, and the markets are responding in kind.
We don't know for sure who that dot actually belongs to at the Federal Reserve. You can have a decent guess.
Come on.
Sure. They're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say, that's Governor Myron, it does not matter. Isn't that a hint, a flavour of what could be coming further down the line in 2026? Isn't that ultimately what the Fed share dot could look like in the next 12 months?
This is the reason why I do believe, based on the market activity, people are putting a disproportionate amount of weight on that dot and on the view, on the dissent, because it is a flavor of who that new Fed chair could be.
We're close to Powell coming out as quick as I can. The markets will police the politicians in Washington.
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are, as he correctly said, Greg said, we're above the neutral rate substantially. They got wiggle room here.
This decision is the easy decision. Without a doubt, we're on the same page on that front. But if anything, you could talk about this Federal Reserve falling into the hands of political actors. This Federal Reserve hasn't hit its inflation mark for years, led by the chairman of the Federal Reserve, Jay Powell, who stepped into the room. Let's take a listen to the chairman of the Federal Reserve.
All right, let's go. Let's listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, The median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, great. And then just as a quick follow-up, I'm sorry, can you, you and other Fed officials have spoken.
Look, man, Samuel, I'm looking at the same thing. Share the same sentiment as you. I'm looking at a strengthening of the DXY short term. I want to take advantage of that, but on the flip side, I will want to dump Nasdaq. That's my take, given what the gentleman has just said now.
Thank
you. You know, it's certainly possible. You know, we're beginning to see. We have begun to see. Goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Thank you.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our, in our policy.
There we go. DXY moving nicely to the upside there. I think you can see it also on your screen there. As I said earlier on, this is what I'm expecting, and I just want to take advantage of that. And I told you, be careful of that euro dollar strengthening to the upside. It might be something that is going to trap you.
To remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in due to immigration. You clearly have a slowing in demand.
I just want to show you guys something with regards to thingy. Heat map, currently AUD is down. US dollar is, I think, is going to gain some strength during this session. I spoke about what do you call it? US 30, a close below VWAP. I always say to you guys, don't follow the noise. The noise is going to lead you astray. Don't follow the noise. Close below VWAP. Look for short positions there, man. It's happening quicker than I expected. This was my take on, look at that thing, man. It's already moving. I can't take this now. It's already gone. This is what I drew earlier on for you. A close below VWAP. Take it to the downside. Possibly aim for 1:2. I know you can say, but Mr. President, look at how wide in that candlestick is. Maybe you could have used this one where you can put your stop loss and possibly go to a lower time frame, 5 minutes, and take this one to the downside. So this is what I meant. This is noise. This is noise. I always tell you, give yourself some time. Don't chase the noise. Don't chase the noise. I told you again, I'll be dumping Nasdaq. Nasdaq is down by 1%. And I told you, be careful of euro dollar. This is the noise again. This is the noise again. Give these things some time. And I've seen a lot of people, they wait for the announcement at 8 o'clock. And they don't realize that the market can also be reactive when Powell starts talking, which is 30 minutes later at 8:30. And that's what we are seeing right now. So I'm still saying, I think I'll be expecting a strength in the dollar. Spoke about DXY as well, that I'm looking to buy. There it is. There it's already buying. I don't know why it doesn't like putting on my view up there, but it's fine. But there it is. There going nicely to the upside now. This is also something that I was expecting, and I shared this with you earlier on. So yeah, let's see. But it's always good to be on the sideline and check how you can take advantage of this market. Don't just rush in for the sake of rushing in.
Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months, and it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
There we go. DXY pumping to the upside, ladies and gentlemen.
Is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So But we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having really a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Neil. Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Andrew.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for
USD CAD, two things there, Samuel. If you want to counter this, I would say discount is at $1 Canadian dollar 37. Then you can go to the upside. The safest trade is this. So yeah, both definitely. I think I wouldn't mind buying USD CAD. But yeah, for those of you that likes taking those risky counters, maybe you can find a counter there. But a close above this level here can give you a nice indication that we can go to the upside. So yeah, most definitely looking at some buy setups there.
The tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where every
Ladies and gentlemen, I also wanted to mention to you that tomorrow we are having a webinar at 7 p.m. So I told you September we're going to be busy. And in fact, from September until December, we are going to be extremely busy. So don't forget that. 7 p.m. tomorrow. The Zoom link, you can find it either on the bio here, or you can be on our groups where you can find it, or maybe go to my Instagram page and you'll find it there also on the bio. So it's a free webinar. It's gonna be on Zoom. So we are discussing why retail traders are blowing accounts. So let me give you some strategies. I've prepared a presentation for you guys, and I just need to polish it there and there, and I'm gonna present it to you guys tomorrow. So please ensure that you are there tomorrow. If you are interested, you can also let me know there in the comment section that I'm in. Tomorrow we are within.
Context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates for it to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here.
Ladies and gentlemen, let's just leave it there.
It just is a pretty much nationwide housing shortage.
We'll continue where we left off tomorrow.
A lot of places in the country just don't have enough.
Don't forget, we have a webinar tomorrow at 7 p.m. I think we've had enough. The markets are not really doing much, but this is what we've been expecting. Gold is selling off now, trading at $3,674 an ounce. WTI also down. Euro dollar also down. So yeah, tomorrow, guys, like I said, I'm gonna be looking at something like this with regards to euro dollar and then taking it to the downside. British pound also the same thing. Don't be fooled by this. This move has already happened. We spoke about it in the morning. We're looking at how many pips? 50 pips or so to the upside. NAS 100 selling again. I'm selling NAS 100 tomorrow. Let me know if you're going to join me on this move here to the downside. German, as you know, this is our daily bread. Maybe then we can sell at this high here, but if we play around this area again, this is what we can be looking at again, depending on how the VWAP is playing. US 30, the trade has already materialized. I see Malawi has already taken this trade. It closed below there, then take it to the downside. Your TP will be around 45,800. Nicely done there, my good sir. Yeah, that's about it, ladies and gentlemen. And we're going to also have a look at crypto. So thank you so much for tuning in. I'll see you guys tomorrow for the webinar. Don't forget, it's at 7 p.m. Central African time. So thank you so much, guys. Have a good evening. Cheers.